Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
How to define what I refer to as Achilles heels for the dollar. And as I said, one of them is your standard run-of-the-mill type of bear market that continues. And the other is one of those that really is a game changer for not only the dollar but the global financial system and the wealth of U.S. consumers in a very, very big way. And that's the second part of this. The first part is the implicit weak dollar policy that we've seen. The next phase, which is the worst phase of a potential bear market or a potential real killer for the dollar, is this idea of the world reserve status being challenged in the dollar. Regarding the implicit, starting off at number one, and we're going to go through that first, we're looking at the idea that using the dollar, we did during the last cycle, to try and drive global growth, try and increase the wealth effect for the U.S. consumer, and try and crank up this symbiotic relationship we had with China, China pumping out more cheap goods, and the U.S. consumers buying final cheap goods at obviously the lower prices increases their purchasing power. So let's go ahead and get into that. The implicit weak dollar policy really started, as I said, back in 2001, 2002 timeframe. Even though the government said that, yes, we have a strong dollar policy, the reality was they were using the dollar, and on this chart the dollar is the red line. The U.S. dollar really was that credit that was pumping out around the globe that was pumping up all the other asset classes. The stock market, all the commodities markets were rising in a very, very big way. Granted, the demand from China was a real fundamental driver of the commodities market, but much of this was liquidity driven when you see the amount of derivatives, as we talked about, that have poured into the market. And the government was kind of happy with this weak dollar policy because of the fact that it really spurred China in a very, very big way. Their economy blowing and going meant lower final good prices for consumers, a lot of free credit in the world so consumers could buy houses. Pumping up asset markets, in particular the U.S. stock market was the black line here, which increased the wealth effect for the U.S. consumer in a very, very big way. So you had a dual wealth driver. You had houses that started to go up around 1998, house prices going up. You had the stock market going up in price. And you had U.S. savings going in this cycle down to about negative 2%. And everything was fine in this weak dollar policy. Multinationals that put up operations in China, shipping back to the U.S., the consumer was buying as much as they could. The U.S. multinationals, when they converted their weaker dollars, currency back into dollars, their foreign sales back into dollars, they showed higher and higher earnings, which was a self-feeding driver, again, for the stock market, which again drove consumer wealth. So it was really a very, very nice game, this weak dollar policy. It pumped up the global economy in a very, very big way. And if anything, the U.S. has become very much the de facto central bank of the world, the Fed. And it seems because of U.S. multinationals driving policy, this idea of a weak dollar enhancing their growth opportunities was a good thing out of Washington. Problem was we had this little thing called the credit crunch, and all of a sudden the credit system was on the edge of the abyss. And the reality was that if at that point in time, had the dollar been pushed down any further in this weak implicit dollar policy, the whole credit system could have come unglued. At a point in time, the Fed, being the de facto central bank around the globe, for the globe, had to have some type of raw material to work with, and it was the U.S. dollar. Had the dollar fallen off the cliff here, even as oil prices had continued up from March, the dollar actually bottomed in March of 2008. Oil prices continued up, but the dollar started to stabilize, and that was kind of a indication to us that something had changed in the world. And I think it was this idea that this couldn't continue if they were going to save the credit system. So we saw a big bounce in the U.S. dollar. We saw some reallocation back into the dollar in a very, very big way as fear came across the globe and deleveraging. So now we're at another stage here, and given the amount of stimulus the U.S. government seems to be throwing into the system, actually not seems, is throwing into the system, it appears that our government is thinking that we are in some type of rebound. The credit markets have stabilized. The spreads have declined dramatically. Some of the spreads between riskier bonds and less risky bonds, if that's even definable now in this market. But ultimately, it appears that the U.S. government is trying to return back to 2001 again and spread dollar-based credit around the world in order to increase global demand. Which means they're pushing again for this implicit weak dollar policy to kick up asset prices, ultimately to kick up this asset prices, and we've already seen a big move in the U.S. stock market, up 30%. Increase that wealth effect, try and bring some modicum of confidence back to the consumer, do something to stabilize housing prices, and they think they can keep this game going, and that seems to be what's in play right here. And as I said earlier, the real driver of this, and this is a very complicated chart. It's actually not that complicated. It looks more complicated than it is, but we put this together here. It's really what we see or saw as the U.S.-China symbiotic relationship. It can be summed up really in a couple sentences. During the boom, China ships stuff to the U.S. The U.S. ships lower and lower priced dollars to pay for stuff back to China. China recycles that money back into the U.S. capital markets, which fund U.S. consumer demand and U.S. asset prices and U.S. housing prices. So that was that symbiotic relationship. China was very happy because they kept driving more and more exports. The U.S. consumer was very happy. He was getting cheap goods and increasing quality goods from China at lower and lower prices. The stock market was going up as housing prices was going up. So why be concerned about this? Well, the reality was it was creating a massive imbalance in the world. Too much production in the East, which was China, and way too much consumption in the West from the U.S. consumer. The credit crunch really changed that, because if you look at the center of this, the whole idea really to keep this game going is this idea of credit expansion, and credit expansion with the ultimate demand driver of the U.S. consumer. So those two go hand in hand. And you've heard during this whole process, I think when the dollar was in the bear market, a lot of the doom and gloomers on the dollar say, well, at any moment China is going to sell off U.S. treasuries because the U.S. dollar is weakening in price. I think a couple things that they failed to either understand or just look the other way, because it made such a nice story and sold a lot of newsletters, was the fact that China knows that the U.S. consumer, this guy right here, is the primary driver of demand in the world, especially for their products. If they sell off U.S. treasuries, they therefore hurt themselves. If they drive up interest rates in the U.S. and hurt the U.S. consumer, they hurt themselves. Secondly, this idea, of selling off treasuries, China created these massive FX reserves precisely because they had to peg their currency to the dollar. They control their currency and don't let it appreciate. So even though it appreciating currency on the U.S. dollar they were getting paid in, the reality was their currency was going down because they pegged to the dollar. What did that mean? That just meant that their export component was even more competitive in the global economy. So even though they were losing money on their so-called investments, on their real investments in U.S. treasuries as the dollar decreased in price, they were really building long-term wealth by increasing their production capacity and their share of the global economy through the exports that they were basically taking from the West. So they saw this as a very nice long-term trade-off for them. So the idea of them dumping treasuries didn't make sense. The big build in treasuries was there precisely because they were suppressing their currency. Otherwise, it wouldn't have happened. Had they had a free-floating currency, you wouldn't have seen that big build of FX reserves, and you probably wouldn't have seen the massive overcapacity that grew in China that's there now.